All right, hello CA Inter students. We're about to jump into a chapter that is, and I'm not exaggerating, the absolute foundation for everything else you'll do in accounting. We're talking about the framework, so let's get right to it. Okay, picture this. You're sitting in the exam hall, heart pounding, and you get this question. A specific accounting standard is telling you to do one thing, but the basic principles in the framework seem to point in a completely different direction. So what's the call? This, my friends, is a classic IKI trap. It's a spot where so many students get tangled up and lose easy marks. And here's the answer, nice and simple. The accounting standard always wins, every single time. If there's a conflict, you follow the AS, period, not the framework. Seriously, pause and write this down if you need to. This one little rule is probably one of the biggest takeaways from this entire topic. So with that golden rule locked in, let's really dive in and break down what this framework is all about.
Okay, so what on earth is this framework? The best way to think about it is like the Constitution for accounting. It's not a law that tells you how to handle every single tiny transaction. Instead, it's the blueprint, the set of big ideas and core principles that all the detailed accounting standards are built upon. It gives us the why behind the rules.
So what does this framework actually do? Well, it kind of wears a bunch of different hats. For companies, it's the go-to guide when there isn't a specific rule for something. For the rule makers themselves, that's the ASB, it's their master plan for creating new standards. For auditors, it helps them figure out if the financials make sense. For you and me, the users, it helps us interpret what we're seeing. It's really the central playbook for pretty much everyone in the financial world.
And look at that, we're back to our golden rule. You're going to hear me say this a couple of times, and for good reason. This is an exam favorite for tripping people up. I want you to burn this sentence into your brain. The framework is the guide, but the accounting standard, that's the law. If they ever disagree, the AS calls the shots. No exceptions.
Okay, so the framework sets the stage, but what's the actual performance? Well, it's the financial statements. Let's break down what they're made of, and just as importantly, who they're made for.
So a full set of financials isn't just one document. It's a package deal. You've got the balance sheet, which is like a snapshot in time of what a company owns and what it owes. Then you've got the profit and loss statement, which tells the story of how the company performed over a period, right? Was it profitable? Then there's the cash flow statement, which tracks where the actual cash came from and where it went. And you cannot forget the notes to accounts. They're not just footnotes, they're critical for understanding the policies and details behind the numbers. All these pieces work together to tell the full story.
Now, we don't just prepare these statements for fun. They're for a whole audience of users, and each one is asking a different question. An investor is thinking, am I going to get my money back, and then some? An employee is wondering, is this company stable? Is my job safe? A bank or a lender just wants to know, will they be able to pay back their loan? Heck, even a customer might look at these and think, is this company going to be around long enough to honor the warranty on the product I just bought? Understanding these different viewpoints is absolutely critical, especially for those tricky application-based exam questions ICAI loves.
Okay, let's move on to something really crucial. There are 3 fundamental accounting assumptions, and we can remember them with the acronym GAC. The most important thing to know is that these are assumed to be true. You don't have to write, "We followed the going concern concept" in your financials. But, and this is a huge but, if you don't follow one of them, you absolutely have to disclose it. That's a big deal. So, the G is for going concern. This is the bedrock assumption. It's the idea that the business is in it for the long haul. It's a marathon runner, not a 100-meter dash sprinter. We assume it's going to keep operating for the foreseeable future. Now, what's really interesting is what happens when this assumption breaks down. If a company is about to be liquidated, for instance, the entire rulebook for accounting gets thrown out the window.
Let's make this real with an example. On the left, a normal P&L. On the right, a P&L where the business is shutting down. The difference is massive. Look at depreciation. We're not calculating it based on useful life anymore. No, we're just looking at how much the asset's sale value dropped. Bad debts? We're not just providing for specific doubtful customers, we're providing for everyone who might not pay. And that deferred expenditure? It's not getting spread out over future years because, well, there are no future years. It gets written off immediately. This is exactly how ICAI can twist a straightforward question, just by flipping that one little assumption.
And the story is the same on the balance sheet. Under going concern, your big assets, your PPE, are shown at cost minus depreciation. But if the company is not a going concern, you show them at net realizable value, what you could get for them if you sold them today. Same goes for your inventory.
the entire basis of valuation shifts from historical cost to immediate cash value. Everything is about how much money can we get for this right now.
Right. Next up in GAC is accrual. This one is huge. It's the whole idea that we record transactions based on when they happen, not when the cash actually moves. So you recognize a sale when you've earned the revenue, even if the customer hasn't paid you yet. And you recognize an expense when you incur it, even if you haven't paid the bill. It's so fundamental that the Companies Act of 2013 actually makes it mandatory.
And this slide perfectly shows why accrual is king. Using the accrual basis, this company's profit is $10,500. It correctly matches the revenues and expenses for that specific period. But look at the cash basis. The profit is a whopping $58,000. Why? Just because a big chunk of cash came in. It completely ignores all the expenses that were racked up but not paid yet. It gives a wildly distorted picture. This is why we say accrual gives a true picture of performance for the period. And the final piece of our GAC puzzle is C for consistency. This just means a business needs to stick to the same accounting policies from one year to the next. It makes perfect sense, right? You want to be able to compare this year's results to last year's. But you can change a policy. It's just that the rules are really strict. A change is only okay under 3 conditions: if a law requires it, if a new accounting standard requires it, or if you can prove the new method gives a much better and more appropriate presentation.
Okay, so we've got our financial statements, and they're built on those 3 big assumptions. But just having numbers on a page isn't enough. How do we know if the information is actually good? How do we know it's useful for making decisions? Well, that's where our 4 quality control tests come in.
These are the 4 big ones: understandability, relevance, reliability, and comparability. You can remember them with the acronym URRC. For any piece of financial information to be considered high quality and useful, it really has to pass all 4 of these tests. It has to be understandable, relevant to the decision at hand, reliable enough to trust, and comparable to other information. Now let's zoom in on relevance and reliability because they come with some important trade-offs. Information is relevant if it can actually change a decision. And a huge part of relevance is materiality. Think of it this way: would leaving this info out or getting it wrong make someone change their mind? But there's a constraint: timeliness. Information that is perfectly reliable but 3 months old might be totally useless. So you're always balancing getting it right with getting it on time. And overhanging all of this is the cost-benefit idea. The benefit of having the information must be greater than the cost of producing it. This area is a goldmine for exam theory questions.
And for information to be truly reliable, it needs to stand on 5 pillars. It has to be a faithful representation of what actually happened. It needs to follow substance over form, which means we account for the economic reality, not just the legal paperwork. It's got to be neutral and free from bias. We have to apply prudence, which is just a fancy way of saying we're cautious. We have to make estimates. And finally, it has to be complete. You can't just leave out important stuff.
The last 2 characteristics are pretty straightforward. Understandability simply means the information is presented clearly so someone with a reasonable knowledge of business can get it. And comparability, which goes hand in hand with consistency, is what lets you do meaningful analysis, both comparing the company's performance over time and seeing how it stacks up against its competitors.
So let's take a step back. We've talked about the purpose of the framework, the pieces of the financial statements, those core assumptions, and the quality tests. All of these concepts, all of these rules, they're all working together to achieve one single ultimate goal. And that goal is to present a true and fair view. This is the finish line. When an auditor signs off on the accounts, this is what they're saying. They're confirming that by following the accounting standards, which are all built on this framework, the financial statements are factual, they're unbiased, and they give a clear, honest picture of the company's financial health. It's the entire point of what we do.
Which brings us to a really interesting final thought. After all of these rigid rules and principles, you might think accounting is a pure science. But then you have concepts like materiality, prudence, and substance over form, which require professional judgment, estimation, and that feels a lot more like an art. So what is it? A science with strict rules or an art that requires skillful judgment? It's something to think about as you move forward. Thanks for joining me today.